presentation. Just spend a couple of minutes on giving an overview of the overall global market and global economy and the local economy and the market. So I'll also request Aakash to spend a couple of minutes on just telling the audience how our current funds are positioned in terms of the sector allocations and in the bets that we are taking in the existing products. I'll just share my screen first. So globally, I think we have had a very volatile calendar year. Lots happening. The Ukraine situation continues. Then we had the additional Israel-Iran conflict happening. Then we had the bombing of Iran. Before that, a little before that, we had the big border situation, Operation Sindoor in India. Before that, we had the parliament having the Pahalgam attacks, and then of course Operation Sindoor. So it's been a really eventful year, and of course, to top it all, we still have Mr. Trump, driving the world up and down from the tariffs point of view. So lots happening in the markets, lot of volatility, and markets have been reacting to such.
I think Mir sir has got dropped. Give me a minute.
Meena, am I audible?
Yes, sir. Now you're audible. So your screen is not visible. If you can just please share it.
Okay. Now is it visible?
Sir, it is visible now.
Okay, cool. So, was my summary on the global situation audible, or should I repeat it?
So if you can just start because it you got dropped, I think, in between. So if you can just start again.
Okay. Okay. So it's been an interesting half year. June 30th, we completed half of 2025, and we had many events, driving markets, driving the global economy. We had the continuing Ukraine-Russia conflict. We had the Pahalgam attacks. Then we had Operation Sindoor. Then we had the Trump tariff situation, which continues as we speak. There's something new every day. We had Elon Musk entering the government, exiting the government. We had then the Israel-Iran conflict, and then we had this massive bombing of Iran by Israel. So, I mean, very unique and unforeseen and unprecedented situations we have seen in the first 6 months of the year. So, to say the least, we've had an interesting 2025. I think overall what's happening is that because of such uncertainty, most of the governments and central banks are in a mood to essentially try to keep rates as low as possible. Of course, inflation is also a concern in some areas, but the attempt is to, tide over the volatility by keeping interest rates and liquidity easy. So we have seen a tendency in the last few months where global central banks are cutting rates, and there is a pressure on the Federal Reserve to cut rates. India cut rates, Europe has cut rates. So to that extent, the central banks and governments are willing to provide enough liquidity to the market and try to buffer the volatility caused by such events. So that's where we are. The capital markets were, in India were kind of again choppy as a result of all these actions. But we did see that in spite of the big, issue with Pakistan on the border, the markets actually corrected for a very short period of time and then rebounded by almost 25 to 30% depending on large cap or mid cap from the bottom of May. So we have had a very resilient market, because of global flows as well as local flows. FIs turned buyers in the month of June, May, and April. So after seeing September to February selling, we actually saw FIs turned buyers. So that's again a positive that, while domestic flows have been strong in any case, now FIs have also turned a buyer. So I think if you look at the overall heat map, situation is improving a bit, So most of the PMIs, which are leading indicators of manufacturing activity and services activity, are okay, in the sense they are not very high, but they are a little bit on the improving side because of all the stimulus and all the actions by the central banks that we are seeing. If you look at the US heat map, it's a mixed bag. The economy is doing okay, but some signs of slowdown, and that is to be expected because in spite of the fiscal stimulus, the interest rates are still very high. So that will have some kind of a impact on the US economy, but not nobody is discounting a big sharp fall, but there will be some slowdown, as you can see in some of the indicators. Uh, in India, the situation is better. We are seeing some improvement in some of the indicators on a sequential basis, June versus May. So manufacturing PMI, services PMI is okay. Industrial production was not that great, but capital goods production was good. So in general, I think there is a little bit of a positivity as far as India is concerned. Inflation is under control everywhere most of the time. So that's the reason why we did see the RBI could also cut rates. So to kind of summarize, I think we are in a situation where the domestic economy is on a slow path to recovery. The government spending has begun, and RBI government both want to provide liquidity and keep interest rates low, so they are on the same side. Inflation is under control. Rural demand seems to be picking up a bit, though urban demand is a question mark right now. But in general, private sector capex sentiment also seems to be better than what it was before. So we have a situation where there is enough liquidity in the market. There is good retail flows and institutional flows coming into the market, and we have a situation where the second half of the year after this lean season, which is the monsoon, should look better, as it looks like we're going to have a normal monsoon, etc. So slow path to recovery with private and government capex both supporting the economy. That's the situation we are building in at this point in time. The portfolios reflect our kind of view around that. Akash, you want to just run us through in a couple of minutes the portfolio positionings?
Yeah, 1 minute. Okay, can you see my screen?
Yes, Aakash.
Yeah.
Right, so coming to the flexi cap strategy. So month-end AUM was close to 1180 crores. This is the way the portfolio is constructed. Top 20 holdings. Top 10 stocks are about 35% by weight. Top 20 or 50 to 53% by weight. Showing your top 10 large caps, mid caps, and small caps. On the left, you'll see how the fund is positioned across market caps. So roughly 50% is in large caps, almost 30% mid cap, and about 15% in small cap. 60 stock portfolio. On the right, you'll get to see the sectoral allocation. So there's a heavy skew towards industrials and financials, the top two, and about 8.5% overweight in industrials and 5.5% overweight in financials. This has been the trend for the last 2 or 3 months. The big underweights are consumer discretionary, 4.5% underweight there, energy 4%, FMCG almost to 5% underweight. So that's how the portfolio is positioned. Coming to small cap, month-end AUM had crossed 1,000 crores. We finished about 1,030 crores. This is the top 20 holdings. Top 20 stocks make up about 40%. You've got a handful of large caps, about 3 large caps. And then on the right, you'll get to see the top 10 mid caps and small caps. On the left, you'll see the market cap split. So close to 5% in large caps, 23% in mid caps, and about 69% in small cap. Sectoral allocation, industrials and financial services again form a massive allocation pie and big overweights. On the bottom, you'll get to see the big underweights: FMCG, healthcare, energy, utilities. So they end up forming the big underweights. So that's how the funds are positioned. I'll turn it back to you, Mihir sir, to discuss the multi-cap.
Sure. Thank you, Akash. With that bit of a background and how the current portfolio looks like, I'll just spend 15 minutes on our multi-cap fund, the new product. And just share the screen also. Is the screen visible?
Yes, sir.
Okay. So a little bit about multi-cap fund. But before that, for some of you who might be joining new, Trust Group is a over 25-year-old group with the promoters having deep expertise themselves in equities and fixed income. Utpal Seth is considered as one of the gurus of equity investing. Nipa Seth is a leading, the largest non-bank debt brokers in the country. Trust Group, which is Trust Capital, is run by Nipa Seth. So we have promoter group which is very on its own, which has very strong expertise in both equities and fixed income. So as you can say, investing is in our core DNA, and our philosophy, as you would remember, is basically that of growth investing. We believe that ultimately it is earnings growth that drives stock prices in the medium to long term. So essentially, to figure out what the stock price returns will be, we need to figure out what the long term to medium term earnings growth will be. And of course, you want to pay a reasonable valuation for that. So growth at reasonable valuation is our approach. We are deliberately not saying price because we don't want to buy extremely cheap. I mean, we don't want to wait for valuations to become extremely cheap. But as long as valuations are reasonable, we believe that earnings growth itself will take care of the stock price growth. So we want to buy stocks at a reasonable valuation with the view that stock price returns will be driven by the earnings growth that the stock will deliver. So to figure out whether a stock is going to be in a high growth earnings phase for a long period of time is what we want to achieve in the stock selection process. So growth at reasonable valuations. What is also unique, as you would remember, in our approach is how we approach valuations. What we have seen and what the market sees is that for stocks with a long runway of high growth, the current market cap or current valuation that you would want to give, or what the market gives to the stock price, the market cap, is not determined by how much profit growth will happen in the next 1, 2, or 3 years. It is predominantly determined by what the market believes is the longer term growth prospect of the stock, and more importantly, how long the growth runway is going to last. So the length of the growth period is what will determine stock prices and stock valuations, even in the short term when you are talking about high growth stocks and sectors. And the value of the longer term profits, which is profits beyond the next 1, 2, 3, 4 years, is called terminal value. So stocks which are expected to grow for high growth rate grow at high growth rates for a long period of time have high terminal value, which means that the 70-80% of the market cap is determined by longer term profits, not the next few years of profit. And this is what we call terminal value investing. So we want to find stocks with a high terminal value, which means that these are stocks which we expect to grow at a good rate for a long period of time. So length of the runway of growth is very important in our investment philosophy. And that's what differentiates our philosophy from the rest of the market. And this is what the gorilla stands for, because the stocks we are trying to pick are rare. They become large and dominant because they grow for so long, and they have a long life of growth, just like gorillas have the longest life of growth. So they are rare, dominant, unchallenged, and long living, long life of growth, just like gorillas. That's why since the beginning, whether it was the flexi cap fund or the small cap fund that we launched, our logo has been that of a gorilla. Uh, to 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 put it simply, there are certain fund houses which pay a lot of importance to growth, and by growth I mean makes next 2 3 years of growth, which typically analysts projecting. So those kind of funds or fund houses are what you can say pure growth houses. There are some houses which pay a lot of importance to value and valuation, so low PE, high dividend yield, that kind of a style. So that's on the top left. On the bottom left is the momentum kind of a strategy where only price momentum matters. We are on the top right. We pay equal importance to growth and to valuation. Growth at reasonable valuations, and more importantly, the way we look at valuations is through the framework of terminal value. So that's basically how our philosophy of investment is distinct from the rest of the market. Uh, so we've always believed that India has a extremely strong long-term story. The 7 Ds, which we are calling them, are driving the India growth story. Democracy, demographics, and deregulation were there since the beginning for a long period of time. So these 3 Ds were there, but out of the 7 Ds, 4 Ds are more recent in nature. So, for example, diversification of manufacturing away from China, D, diversification, is something that is emerging in the last 5 7 years, because now the world wants to reduce defense dependence on China. So that's diversification of manufacturing. We also have diversification of our own economic activities. So new sectors like green energy, semiconductors, etc., electronic manufacturing are coming up, which were not there earlier. So within our economy also, we are diversifying our economic base. So diversification is another D that has come up more recently. Digitization is something that has happened in the last 10 years. The UPI, Jandan, Aadhaar, India Stack initiative is changing the way we do business, we do our transactions, and it's unique and the fastest and cheapest in the world. That is helping India to grow much faster and at a low cost. And that's something which is unique to India, because we have leapfrog technologies. We never went to a computer. We straight away went to mobile, for our transactions. So that's something unique, which is helping us grow at a much faster rate. Dynamism is the entrepreneurial mindset that has come up in the last 10 15 years. Now we have a large pool of capital which is available for risk capital. Earlier banks were the only sources to get capital, but now we have venture capital, private equity, mutual funds, insurance. You have large family offices, PMS schemes, AIF schemes, which are basically willing to understand the equity risk and willing to provide equity capital for ideas. So for people who have ideas, want 5 crores, 10 crores, 20 crores of seed capital, earlier it was not available. Now it is available. So this whole ecosystem of risk capital availability has, spurred a lot of literally thousands of startups, and we are seeing rapid innovation across fintech, consumers, and many other fields. So this dynamism of India is something that is come up because of the mindset which was already there, but because of availability of risk capital. And fourth is debt capacity, which we believe is, the function of our conservatism. Our government at the country level, we have not leveraged too much. We don't have too much internal or external debt compared to others. Our corporates have also deleveraged in the last 10 years. So corporate debt to GDP, corporate debt equity is also low. And the households have also been conservative, and we are not over leveraged. So while the leverage has gone up in the last few years, it's still much lower than the capacity and much lower than what the world standards are. So we have, these 4 Ds which are driving India, which have come up recently. So these 7 Ds are basically very long-term in nature, and they provide the tailwind for long-term economic growth of India. Based on these 7 Ds, which are the sectors which benefit? So if you see our portfolio, it mostly reflects these kind of initiatives, these kind of themes, I would say. Uh, Premium consumption is one area which we believe will grow for a long period of time. Uh, all premium items like goods and services. In services, you have hotels, airlines, travel and tourism linked services. In goods, you have all the premium goods like gems and jewelry, liquor, high-end real estate, high-end two-wheelers, high-end SUVs versus cars. So all those segments will grow faster. The second is financialize of savings. So the whole ecosystem linked to savings can grow faster for a long period of time, right? So you have insurance, broking, asset management, wealth management, exchanges, etc., which can grow for a long period of time. So this is one theme that we like. And the first row, the theme is linked to demographics and savings in the country. The second bunch is physical asset creation. We believe that we are short of all kind of physical assets, whether it's manufacturing capacity, whether it's infrastructure, real estate. Within manufacturing, you have sub-segments like defense, railways, etc. Everything in short supply. So this theme of physical asset creation can last for a very long period of time. And third is, of course, the digitization and technological disruption theme, where new age companies, etc., are growing faster. So these themes we believe will grow faster than the rest of the economy. So this is the broad preference, that is reflected in our existing portfolios, as well as will get reflected in the future portfolios also. So the reason why we launched the small cap fund second after flexi cap, which is I would say the core flagship fund. The reason why we launched the small cap fund is basically because of the fact that the the opportunities are there in the mid and small cap. So you need to pick stocks from all market caps. Today what has happened is that the equity market has become very wide, right? So the definition of mid cap, which is the 101st stock, starts at 1 lakh crores almost. So the 101st stock, which is the largest mid cap, is now almost 1 lakh crore in size. And the largest small cap is now 33,000 crores in size. This used to be one-fourth the size. So the largest mid cap 5 years ago used to be about 25,000 crores. Now it is close to 1 lakh crores. The largest small cap used to be 8,000 crores. Today it is 33,000 crores. So 4x. The number of companies with a market cap of more than 2,000 crores used to be 500. Today it is almost 1,100 companies. So the market has actually given much more opportunities in the mid and small cap space. The number of companies is larger, as we will see, and the market cap has also increased. The market cap of those level the top market cap of all companies with a market cap of more than 2,000 crores 5 years ago, if you were to break it up into large, mid, and small, it was almost 80% large cap. Today, the 1,100 companies with a market cap of more than 2,000 crores, if you break it up, 62% is large cap. So the you know the concentration has reduced in the market, and we have a lot more representation of mid and small caps in the market cap. So if you look at the multi-cap, coming to the topic, which is multi-cap fund, the multi-cap benchmark is actually 50 large cap, 25 mid and small cap, right? Because you need to invest minimum 25 in small, minimum 25 in mid, and minimum 25 in the large cap. And so the multi-cap benchmark is the flexi cap benchmark, which is NSE 500. So multi-cap benchmark is NSE 500, but with a 50, 25, 25 weightage to large, mid, and small. So if you look at that 50, 25, 25, it is now actually quite close to the 60-40 that the distribution is in terms of stocks with a market cap of more than 2,000 crores. So the multi-cap benchmark actually brings you closer to the actual market, as you can see. The other thing, of course, is the fact that not all caps perform at all times. So in the last 19 years, if you were to see, large cap has been the best performing index 7 times, mid cap 3 times, and small cap about 9 times. So 9 times the small cap has been the best. So you can see that it's not every year that all indices work. So you essentially making the point that it's good to have a balance. So apart from the market cap distribution, which is also now 60-40 large versus mid small, the performance is also differing year by year. So if you have a multi-cap approach with exposure to all caps, then you get a more balanced kind of a risk return profile. If you look at sector also, the opportunities are across the board. So for example, financial services, they are maximum represented in the large cap index. But discretionary, which includes auto, etc., gets maximum representation in the mid cap index. And the other high growth sectors like industrials, pharma, healthcare, etc., they have the maximum representation in the small cap index. So if you want to go for high growth stocks and sectors, you will have to look at opportunities across the board, across all market caps. This is another study that we did. What we did is that we took all the companies with a market cap of more than 2,000 crores. As you know, as I just mentioned, number of companies with a market cap of more than 2,000 crores is about 1,100. And the market cap of those 1,100 companies totally is approximately 450 lakh crores. What we did is we divided all those 1,100 companies into sub-segments, which is sub-sectors or sub-segment as you would call them, which are potentially high growth and others are normal growth segments. So high growth segments would be segments that we just described, like, the capex theme, the financial savings theme, the consumer discretionary theme, the premium consumption theme, etc., and the new age, etc. So there are dozens of sub segments in the market. So each stock we divided into the potential high growth segment and the normal segment. So out of the 450 lakh crores, 1/3 of the market cap is in the potential high growth segment. Okay, so about 150 lakh crores. So that's that's one interesting statistic. But even more interesting, if I were to break up this 33% into large, mid, and small caps, so this 33% is subdivided into this pie, then the pie is equally distributed almost, 40% large cap and almost one-third in small cap and mid cap. So the message is that if you have a vision of going into the high growth segments, then the opportunities are almost equally distributed across market caps in terms of the market cap distribution. So again, making the case for a multi-cap fund where it's good to have a presence across all market cap, because even the high growth segments are distributed across market caps. So to summarize how the classification of funds is, large cap fund means minimum 80% large cap. Mid and small cap is minimum 65 in mid and small. Large and mid fund we have minimum large cap 35, minimum small cap 35. And the multi-cap fund basically has minimum each of large, mid, and small. So that's how the lay of the land is. And flexi cap fund, of course, has no limits. Risk return dynamics, if I were to say, the multi-cap fund has given returns more than the large cap, but little lesser than the mid and small cap. So it's in the middle, right? But risk-wise also it's in the middle. So it's a little more volatile than the large cap index, but less volatile than the mid and small cap indices. So it offers you an optimum balance between the risk and the return. If you look at the benchmark, I said the FlexiCap benchmark, which is the NSE 500, has approximately 72% large cap, whereas the multi-cap benchmark is 50% large cap. What has the industry done? In the FlexiCap funds, the average allocation to large cap is about 58%, 60%, or 58, 60%. Whereas in the multi-cap fund, the average allocation to large caps has been about 40%. So there's a 20% difference, which is a significant difference between the allocation to large caps. And of course, the balance goes to mid and small caps. So the multi-cap category is more evenly distributed across large, mid, and small. Yeah. The category has grown very well. In the last 4 years, it's grown up almost by 10x. It used to be a 20,000 crore category, 20,000 crores category. Now it's almost 2 lakhs crores in AUM. So it's been a well-received product because of the more balanced exposure. So in summary, why multi-cap? It forces the diversification into all market cap segments, because in FlexiCap, we have seen that while you can theoretically put money in any segment to any level, the industry has been more biased towards large caps. And as we know, in the last 5-10 years, small cap and mid caps have done well compared to large caps. So we have seen that the multi-cap benchmark has outperformed the FlexiCap benchmark, which is the NSE 500. So it forces you to do stock picking. It forces the fund manager to do stock picking and look at opportunities across market cap, not be biased towards the large cap only. So it kind of also we can say it mitigates the behavioral risk and timing risk. And risk and reward, we saw the returns are between large versus mid small, and the risk is also between large and mid small category. We compare, flexi cap versus multi cap. So, sorry, this. Okay. So anyway, so FlexiCap for us is like a buffet. There's something wrong with the formatting. Is like a buffet where there is too many choices. You can eat anything to any limit. Whereas the multi-cap is more like a fixed thali where you have to have minimum 25 in each, large, mid, and small, and then you can pick and choose the rest of the 25%. So it's more like a I would say a kind of a fixed thali versus a bouquet comparison. So essentially that's it from my side. Happy to take any questions that you may have on the fund or the markets, etc.
Thank you, Mihir sir. So we already have a couple of questions lined up. Why multi-cap fund launch? I think you just answered that, why multi-cap fund, but if you want to add something to it, sir.
Sure. So first of all, as you can see, we are a young fund house, so we have to finish our offer at least the basic core funds to our investors. So we started with the FlexiCap fund. Good response from 550 crores in the NFO. We have grown to 1100 crores. The small cap fund we launched about 7 months ago. That also has grown well from 360 crores in the NFO. We have grown to 1,000 crores plus in the small cap fund also. So I think we are getting good responses in our fund, and we want to make sure that we have at least all the core products available for our investors. And multi-cap is definitely a core product in the category. As you can see, the growth in the category has also been very good. Multi-cap, category is almost like 2 lakh crores in size. So that is something that we cannot do without in terms of offering. But I think more importantly for us, it is our core belief, as you can see, that there are opportunities across market caps, and you can't just focus only on one type of a market cap. If you notice in our flexi cap fund, which is now 14 months old, if you look at the 14 portfolios that we have published, there have always been more than 40% plus in exposure to mid and small caps. So our mid and small cap exposure has been significantly higher than the industry. We've been taking active bets in the portfolio, and for that reason, we know that there are opportunities across all the asset classes, and our growth philosophy basically takes us to all market cap categories. So a multi-cap fund basically is kind of as I said, a way of making sure that you have presence across all the market caps. You don't ignore any market cap, and the fund manager does not become too conservative and doesn't become too large cap bias. So it's a good product for the investor to start exposure across all the categories.
Thank you, sir. So we have another question. What is the reason IT stocks not in the portfolio?
We have IT stocks in the portfolio. Mostly, we are more overweight on stock-specific selections in the IT space. And if you see, those are mid-cap ITs. The large-cap IT companies are good companies, cash flow generating, high ROE, high ROC, but the growth is not there. So we are talking about large IT companies which will deliver probably 5 to 10% growth. And for a country like India, that's not very exciting growth. So while they are very good quality companies generating a lot of cash flow, good margins, stable businesses, they are not the fastest growing segment in the economy. We are biased towards growth. We want to see good growth and of course pay reasonable valuation for that. But growth has to be there.
Thank you, sir. So there's another question on how do you plan to manage the sector concentration risk in multi-cap?
Sector concentration risk in multi-cap, we will run in the same way that we do for the other funds, which is essentially, as you can see, that we will take bets, we will take active bets. We typically have a high tracking error, but what you can see is that we control it at the stock level and at the sector level. So typically, if it's a small cap stock, we will not have more than 2 to 4% exposure. If it's a mid cap stock, maybe 3 to 5% exposure. Large cap stocks, we can go higher. And that is also overlaid with the sectoral bets. So as you can see, we have a sectoral overweight underweight, but typically 5 to 10% is the maximum overweight that will go in a particular sector compared to the benchmark.
Thank you, sir. There's another question. Is there any monopoly stocks in the portfolio? Is there any monopoly stocks?
Monopolistic probably.
Right.
So there are stocks which have good entry barriers. As you know, these days the entry barriers don't have to be physical assets linked. A lot of it is intellectual property, technology, brand, etc. Size itself becomes a barrier in some cases. So, for example, if you look at some of the banks, they have become so large that you can't really generate the cost of funds that they are able to generate the low cost of funds because of the reach, etc. So we have, not we can't say monopolistic, but we have a lot of companies which have good, high entry barriers or are very efficient in terms of competition because of the scale and the technology that they use. Akash, do you want to add anything on those lines?
Yeah, so like you rightly said, we don't have monopoly stocks, but there would be probably strong duopolies. Like if you look at the telecom industry, it's not exactly a monopoly, but there are about, give or take 2.5 players controlling the market, close to three. If you look at the airline industry, there is one person who controls the entire profit pool with 64-65% market share. So we've seen that we have some stocks like that, and from time to time we keep evaluating. We would rather look at companies which have low market shares, which are already not monopolies, and which can become very high. So typically, we get excited when we see companies with 1 to 2% market share in their sectors, and over 5 to 10 years, that market share can go up meaningfully. So that's why betting on future gorillas, betting on potential gorillas, is what we would rather do than rather bet on already existing monopolies.
Thank you, Akash. There's another question. Given the current valuations across market segments, where are you finding the most opportunity?
So we are finding opportunities across the board, frankly. Uh, As you can see, we have about seven in the flexi cap fund itself. We have about 17% small cap. We have about 28-29% mid caps. Balances in large cap. So we are finding opportunities across the board. I think it's also important to keep in mind growth while talking about valuation. Because typically we just look at the PE of the stock or the index and try to say whether it's cheap or expensive. But that has to come, that has to be looked at in conjunction with growth. So for example, if the large cap index is trading at about 18-19 times forward PE, that's against the growth of about 8 to 10% that is expected in the next couple of years. But in the small cap and mid cap indices are trading at 20 to 24 P on a forward basis. That has to be considered looking into account that they are expected to grow at much more than the large cap, probably around 15-17%. So, so you would want to pay a little bit of high multiple for higher growth. That's the way we look at indices. That's the way we look at sectors. So for us, I think the risk return balance is kind of equal in all the three indices, adjusting for growth.
Thank you, sir. There's a question. How many stocks will be typically be there in the portfolio?
We keep the portfolio around 60 stocks, 50 to 60 stocks plus or minus. And that as you can see, we've done that in the flexi cap fund, in the small cap fund, and most likely in the multi cap fund also, it will be kind of a similar approach.
Thank you, sir. Currently, we have no further questions. I would request participants, if you have any questions, please put it in the Q&A section. So there's a question, can good market situation to invest the fund? I think they want to know the market situation, current market positioning to invest in the fund.
Sure. So as you know, the backdrop is kind of turning better. As I mentioned, we are expecting that the Indian economy is kind of turning around and showing signs of growth in the investment cycle. So consumption has been good even for the last couple of years. That's been driving. Government spending has been driving, but we need private sector capex to pick up. Last year, there was a little weakness in the government sector, capital expenditure. But this time, in the last 3, 4 months, they have come back and they are spending in a good way. We are also seeing additional allocations to defense because of the border situation. So that I think is giving good support from the government side. Private sector investment cycle does seem to show some signs of green shoot. So the second half is expected to be better. And given that situation, we do believe that, it is good time to, be in stocks for India, especially when we see that the dollar is weakening. The reason why we saw FI outflows from September to February is basically it was against a weaker dollar situation. Sorry, stronger dollar. The dollar was strengthening. But now we have a situation where the dollar is weakening against most currencies. And given the fiscal deficit that they are running, given the money printing they're likely to do in the US, it looks like the dollar will stay weaker. So we'll probably have the tailwind of global money also coming into the country. And you have seen that April, May, June, FIIs have been net buyers. After 4, 5 months of selling, we are seeing FIIs also turning buyers. So economy doing well, local flows are anyway very strong, and global flows will also should continue. To that extent, I think it's a good situation to invest.
Thank you, Mihir sir. We have no further questions. So before we conclude the call, I would just like to say the NFO is currently open. It's closing on 14th of July. So we request your participation in this NFO to make it a big success. Thank you, Mihir sir. Thank you, Aakash. And thank you everyone for joining us today on this call. Thank you.
Thank you.
Thank you.